Hey guys, it's Bitcoin George here. It's been a while since I've come on and spoke, so I apologize for the lack of content lately. But just been busy working, trying to make money, and taking care of other things in life. And I have wanted to get in this space and keep talking, but I haven't been able to. Today is a continuing of my previous video talking about the stock market and how it's influencing the rest of the financial world. So we'll call this economic update part two. And the title of this video, or the theme of this video, is something I want everyone to think about, which is this term that I've heard by another finance influencer, YouTube guy, and he talks about mean diversion. And he talked about this like a year or some odd ago, back before everything started to play out in in the way that the market is correcting right now. But mean diversion. So think about that, and we're gonna get into what is going on in the market right now and how mean diversion is going to play into this current economic situation we have. All right, guys, so I want you to take a look at this chart before I get into what's going on. And this is a chart on the Zillow stock. And the point of this is to show you that in March 2020, we were at a certain level. The stock went way up high to the middle green zone of that chart. And now on the right, we are back on the same level as we were 2 years ago. And now it is actually broken lower and is continuing to depreciate below the level that it was prior to all the stimulus related to COVID. And Zillow is one of the first stocks to show this, but I think a lot of other stocks, especially these big tech stocks, all the FANG stuff, probably going to do the same thing. So I'm going to reference this chart multiple times in the video, but hopefully this gives you a better reference of what I mean when I talk about mean divergence. So last time I did a video, it was the middle of April, and Netflix had just crashed. That was kind of the first domino to fall. Netflix went down about 40% in a couple days. Since then, the market has had pretty much 2 weeks of red days in a row. And a couple of those days have been big days. I think last Thursday, after the Fed came out with the half point rate hike, Thursday, stocks got crushed. NASDAQ was down another 5%. The stocks at this point, most of them have given back all of the gains that they made from March 2020 through the 2-year bull market when Mr. Jay Powell let the printers run loose and the government printed $80 trillion or whatever they did. I don't know. But the stock market, if you look at the S&P 500, the NASDAQ, the Dow, basically from March 2020 they went up, and then if you compare it to now, they've come back to the same level that they were at prior to the COVID situation. And I think they're going to keep going down. I think we're gonna keep seeing a big pullback in the stock market, which really is, aside from real estate, is the backbone of the American economy. Everyone who is saving for retirement, 90% of those people have money in the stock market. Most people do not stack the shiny stuff. A few people do, but most people rely on the stock market to work their money for them and grow it. And right now we're having a huge contraction in the stock market. So what I was talking about before is this term called mean diversion, and basically what I just talked about, the stock market going up from March 2020 until about November 2021. But about a 20-month period where it had crazy appreciation. And now, in the last 6 months, we've lost all that appreciation. And if you look up most stock charts, we're pretty much at the same level on stock prices that we were 2 years ago. So all those gains that came from the COVID crisis have been wiped away. And one of them in particular that is interesting to me right now is Zillow. Zillow is a real estate company. And something I talked about in a previous video is the stocks, the individual stocks, as well as the stock market, is a way for us to measure the productivity of a company. And that ratio is not always in effect. And the stock market in the last couple of years has been a poor example of that, because the stock prices went up, but productivity did not match. So you have a disconnect between the stock price and what the company's actually worth, and the market's trying to find that right now. And in the last year, those stocks went up and then they came back down. Where this term mean diversion comes into play is, if we break that down into two separate words, you have mean and you have diversion. The mean would be similar to the average. It's going to basically say, like, it's a mathematical term, and frankly, I haven't been in math for long enough to remember exactly what it is, but it's similar to an average. It's basically like if you were to plot every data point on a graph, you would split the difference in the middle and see where it is, and that would be the mean, I think. But either way, it doesn't matter. What is important here is the second part of this, the divergence. So you have mean and you have divergence, and when you put the two together, you get this term called mean divergence, which talks about when something differentiates from the projected path that math would tell us to go to. And I think a lot of technical traders are looking at charts right now and looking at these previous points, which were very strong resistance and support levels. And right now we're at one of those right now, which is basically we've come back down to where the stock market was prior to COVID-19. And a lot of people are thinking that those levels are going to hold. And so you got a lot of fear in the market, but you also have people who are not making smart decisions because they feel like they're behind, because anybody who bought after March is now in the red. If you're in the stock market, or even in crypto, if you're in crypto, you're in the red. And these equities have been depreciating so fast in the last 6 months because of the rate hikes. The Fed is trying to cool off inflation, and in doing so, they're just crushing the stock market and the equity market. And these stocks have so much downward momentum right now, they're going to divert from the mean, and they're going to go lower. And it's kind of like gravity. If you drop a bowling ball off the top of the Eiffel Tower, and it hits somebody's house on the way down, it's not just going to stop when it hits the roof of the house. That thing is going to keep dropping. Really, it has a lot of force in it. And the same thing is happening with these stock prices. They had so much upward pressure forcing the stock prices to Star Wars numbers in such a short period of time. Physics, this is Isaac Newton's third law, I think, is every action has, or maybe that's the first law, but every action has an equal and opposite reaction. And these stocks had so much upward pressure, and now they've hit the point where they can no longer go higher, and they have to come back down. And the Fed is trying to kind of control that drop, but there is so much downward pressure now that I think these stocks are going to keep going lower, and you're going to keep seeing bigger and bigger pullbacks. I've seen a lot of different guys on social media talking about, I've seen one guy in particular, and that's Michael J. Burry, the guy who predicted the '08 recession. And he showed some charts the other day talking about how in 1929, in 1980, and in 2000, all of those markets, when they did correct into a bear market, they went lower than the previous bull market's all-time low before they began to correct again. So I would not be surprised if we see another 20% move down in the stock market and in cryptos. All these equities, and I don't want to call Bitcoin an equity because it's not. It's a commodity. But the world doesn't know that yet. Bitcoin is trading like a tech stock. And I think a lot of people are afraid and worried about Bitcoin right now. So you're going to see a lot of selling in Bitcoin. It's going to have a lot of downward price action. And so I'm not really making any big moves to purchase right now because I think there's still a lot more low that we can go. And once Bitcoin gets down around the 20 to 25,000 mark, I think that's where I'm going to buy, because we need to go back and retest that previous all-time high from the 2017, 2018 bull market. Since we passed $20,000, we have not come back down anywhere near that. And we need to test that as a resistance or as a support before we can go back up again. So I would not be surprised if in the next 3 months we see a $20,000, $25,000 Bitcoin. The stocks are going to keep getting crushed, that's pretty much. I mean, I want to go a lot deeper on this, but I want to keep this video shorter than 20 minutes or so. But I would like to just briefly mention one thing, and that is the Zillow stock. And Zillow stock is getting crushed right now. And I think this will be my little teaser for the next video I'm going to do, but I need to get more educated on this topic before I speak formally on it. But Zillow stock is getting crushed right now. And like I talked about a couple times, these stocks are great markers for how actual companies are doing. And Zillow, if you're not aware, is probably the number one stock traded by retail investors related to residential real estate. So not commercial real estate, but houses, the housing market. And Zillow, and this is the same thing for commodities too. Guys who talk about the commodity sector, talk about gold and silver. Typically when we're going into a gold and silver bull run, where you're going to see a lot of upward movement in gold and silver stocks, the mining companies, so the companies that are actually doing the work, they're laying the foundation for that product to come to market, they lead the bull market or the bear market. So they are the first to respond because those are the guys that are on the front lines. So they get hit with it first. And so when the mining stocks start to move, it's a good sign that it's a pretty good indicator that the physical price is going to move also, but it's going to be in a delayed response. And you're seeing the same thing happen with Zillow right now, and that is why I think you're going to start to see a pretty big correction in the housing market. It seems to me that houses are not selling like they used to in the last 2 years. I see a lot of houses in my neighborhood that have been on the market for over 30 days. That wasn't happening 6 months ago. These high interest rates are just crushing the housing market. And I think we're going to have stagflation in the housing market, and that is going to drive the price extremely low, because you have people who are sitting on a ton of equity who previously owned a house. They have a really good opportunity to sell that house and capitalize on a lot of profit, but they can't use that money to buy another house because you got to live somewhere. But the inventory issue is really bad because there's not enough inventory on the market right now for someone to sell their house and buy another one. It doesn't really make sense in most situations. And on top of that, if you got somebody who's signed at a really good interest rate, like 3%, and if they sell their house and they have to buy a new house, you can't get a mortgage rate for 3% anymore. They've doubled in the last 3 months. They went from 3 to 6%. So that right there is a huge incentive for people not to sell their house. The problem with that is, and this is why I need to get more research, but if in order for this real estate market to stay hot, you need volume. And if sellers don't want to sell and buyers don't want to buy, we have a stalemate, and it's going to crush the volume. And what that's going to do is force the price action to move very, very aggressive in either direction. You're either going to have people who are desperate to get into a house who are overpaying, or you're going to have people who are freaking out that they're not going to be able to capitalize on the equity that they've built up in their house, and they're going to try and sell it really quick. And the only way to do that is lower the price. And so you're going to get, I think we're going to start to see more people doing the latter, and it's going to create kind of like a bank run on the housing market, where all of a sudden in 3-6 months, there's going to be so much inventory on the housing market because everyone's going to want to try and capitalize. They're going to try and sell the top of the market. Oh, we want to sell before the market corrects. Well, too late. It's already corrected, just the price doesn't reflect that. So I don't want to get too deep into that because I need to do some more research before I start making predictions and telling people what's going to happen. But Zillow is tanking, probably because the stock market is tanking, but also there might be something else under the surface that we can't really see yet because it's going to affect the actual market downstream. It's a delayed response. So we'll see what happens. But in the meantime, guys, thank you for watching this video. I hope you enjoyed it. My man Jerry, if you come across this, bro, you're the man. Keep killing it, dude. I'm sorry I haven't been making as much content. Just life is getting in the way. But anyways, you guys keep stacking silver. Keep stacking as much silver as you can. Don't take on any debt right now. Stay away from debt because there's rough seas ahead of us. So just sit on the sideline and hold off on buying that new couch or a new car or whatever you want. Just sit still, because I think there's going to be some really good opportunities to buy some undervalued assets in the next 6 to 12 to 24 months. So that's all I got for you today. Enjoy.